Hello and welcome to Investing Confidential. The Fed is about to make a grave policy error that's going to sink stocks and bonds. I'm going to talk about that in a second. I recorded this video a little earlier from Chile, so right after the close. So I wanted to mention a couple of things, the last few things about this Silicon Valley Bank. That's why I call it Silicon Valley Bank. And then I'm going to go into why the Fed is going to crush your stock portfolio. And here's important. Look at the timeline here. As you could see, going back to the end of February, you had these morons from Moody's, which are completely worthless, meeting with Goldman Sachs. I mean, this is ridiculous, okay? They all knew what was going on. Okay, they all knew what was going on. Then you had you saw the CEO and CFO selling stock, and then the whole thing just collapsed. So, who do you blame here? Obviously, the management, a bunch of fools, don't know how to run a bank. They're like VC guys running a bank, which is ridiculous. You've got people like Moody's and the US government, the regulators, who just totally missed this thing. I mean, they saw what was happening. They didn't say anything. And boom, the massive collapse. But in the end, this all doesn't matter because, all you had to do was look at this balance sheet problem that you're seeing here. I mean, you got interest bearing deposits in general, representing the entire, what we call the liabilities of the bank. On the other side, these guys invested almost $100 billion in illiquid debt. I mean, this is insane to give higher rates. And the problem is it didn't matter what they paid out. They did it anyway. And so, there's a lot of blame to go around, but I'm not going to mention anymore. It really doesn't matter. The bank was bailed out, and that's a problem. As you can see here, the reason for the problem is now, okay, they call it a banking crisis. It's not a banking crisis, but they call it a banking crisis. And now everything's turned around in terms of the rate increases. It's like inflation doesn't exist anymore. This is absolutely insane. So that's it. It's done. They bailed out all the depositors, which was a mistake. But the real issue here is the Fed. Okay, as I mentioned to you, the real issue is the Fed. Today's action shows, and also if you pay attention to what's going on, that there was not systemic risk to the system, okay? But why on earth would you pull back on the rate rises? Okay, inflation is not going away. In fact, you could make a case that it's going higher. But we all know why. We all know why. And this is because it's government pressure. The tech giants, who are basically potentially the big losers here, wanted to get bailed out. And at the end of the day, now, they don't want rate increases, okay? And it's the economy, right? They don't want the economy to go down. The government doesn't want to slow down. So the private equity, the VC guys who are pulling the Fed strings and Biden strings, they don't want to slow down. And they're not going to, and as far as they're concerned, they're not going to get one, but they can't stop it. Okay. So look what's happened. In 2 months, we've gone from expecting a pivot and a big rally in stocks to 25 bips to 50 basis points rate rise last week. And now we've got a pivot again. And it's even worse. Look at these expectations for March now for the Fed meeting. It's almost zero. It creeped up to 50, and overnight it's almost zero because there's some bank had bad management. Okay. Look at the terminal rate now. It was on its way to 6, just collapsed. Okay. Look at the 2-year. Again, heading higher, collapsed overnight. And now, as you can see here, the so-called experts are predicting a rate cut in July and into the end of this year. That's insane. Okay, it's insane that we could be headed in this direction when at the end of the day, nothing has changed on the inflation front. Okay, you have this employment data that came out Friday. It's completely miscalculated. I'm not going to say it's fake, but it's really doesn't mean anything. But so they're saying now that there's more people working than ever before. So as you see here, these jobs are mostly temps and hospitality. These are very, very low wage jobs, not full-time employment. Okay, they're part-time essentially. They don't pay a living wage. People are taking them because they're tapped out. They're tapped out of unemployment insurance, etc. Okay? And now the Fed is about to make, if it goes down this path, a major policy error. Okay, they've made policy errors in the past. Okay, we've seen them before, but this one is going to be really bad if they take this path. And it looks like they may. The pressure's on them. Okay. Inflation will come out this week. I don't know if the number is going to be manipulated, but inflation over time, folks, is going to be above 5% and will keep going higher, especially if this Fed stops. Okay, there'll be a massive rally in financial assets, increasing inflation. So, what to do here? I would stay buying short term bonds. I would not go past a 2 year duration. Okay, and look at gold. Okay, gold is moving, and this is not because of systemic risk. Gold is moving is because we are in the beginnings of a US dollar decline. Okay. Dollar had a giant move for decades, and we are in for a long period of time, probably 5 to 7 years of dollar weakness. And as an investor, you need to put US stocks aside. Okay. You can't be invested in US stocks, with maybe the exception of defensive small caps, but you've got to look overseas. You got to have some gold, okay, and even certainly Bitcoin. But at the end of the day, if you're an investor and you're seeing all this nonsense, and if the Fed pivots, obviously there's going to be a massive rally, but it's short term because that would be a policy error, okay, for sure, a policy error, and all that rally will be reversed. So, from Chile, I tell all you investors, be careful out there.